You can hear me. I'm almost ready. Oh, something's slow today, slower than me. It's like YouTube won't go. Try one more time. Add video. Nope, won't do it. All right, so we're spinning. No video loading, huh? Oh, well. All right, so nothing's loading. All right, forget it. Morning, everybody. Welcome to forex.today. Let me remind you that trading is risky, not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results. Please stay small, stay humble, focus on the long term, and never risk when you cannot afford to lose. Thank you to everyone who is posting their trade plans on forex.today, or leaving comments, feedbacks, and likes, and all that kind of stuff. For those who are strong and confident enough to post their trade plans. My name is Wayne McDonald. I'm the Chief FX Market Strategist for TradersWay.com. Swing on by to TradersWay.com. Open up your account, give us a test, try out our services. Choose ECN, fixed or variable spread accounts. I'm here every single day, 7:30 in the morning. Well, Monday through Thursday. You'll find me the first Friday of the month at fxstreet.com, where I do non-farm business live. And I've done that for over 130 months. That's pretty cool. All right, so let's move on.com. Well, today we have an FOMC decision. Interest rates in the United States very likely to rise, as you know, well over 90% now. Cool. So they're going to raise interest rates. We're interested in shifts in dot plots. We're interested in shifts in language and all that kind of stuff. Because we're trying to figure out ultimately where are we going to be at the end of this year? Where are we going to be at the end of next year? Where will the Fed feel comfortable as far as their normalization process? Is it 2%? Is it more than 2%? When? Of course, all of that's data dependent. So if they tell you where interest rates are going to be in 2018, 2019, doesn't really matter, because that information will change over time. So, yeah, Ryan's saying if oil's coming down, that's going to kill the whole idea of inflation. You're right. So that could change. That could be the component that changes the dot plot. So let's just go back over. Right. Let's just go back over. All right. So where did we leave oil? I said it would be very, 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 very dangerous to sell this further, right? And if you were going to do it, I think at the last second of desperation of something to talk about, I said you could do it on a 1 minute chart off the red zone, but you better be very bearish. I think 99% of the message was you can't actually sell it here. Is that how you guys remember it? this yellow area. I said, why didn't you sell it at 55 or 54 or 53 or 52 or 51 or 50? Like, why do you wait for it to hit 49, 48 and then sell? Right? Like, it's just silly to sell it down there, right? Right? That's how you remember it. And then, of course, go back in there. And it's recovered a bit, and it's back over 49. It hasn't really fallen. It hasn't really risen. We're only into the second level here. Could you see the importance of identifying the old levels of support and resistance? And you carry forward. Well, we'll just call it central. Oh, it made me want to cry? Really? Oh, because it made me nauseous. That's right. All right, good. So we all remember that. Didn't make me cry. Yeah, it made me nauseous, which means I want to vomit. Well, good coach then. Yeah, good coach. That's some good coaching right there. I like the way you trade. No, I'm still sick, but don't worry about that. It's funny though. I think that trade is the one that made me sick. Ah, the coffee's good. So, anyways, yeah, where could we be going? Well, I mean, look at that. It's silly. It's so high up there, but you know, what are you gonna do? Huh? What are you gonna do? Okay, look at that. Just beautiful stuff. Beautiful price action. So maybe a little bit of a recovery. Maybe we're ready to buy dollars again. Maybe around 2 o'clock. Well, we didn't get the spike back into the wedge. We're waiting. What does the hourly tell you? It would rather go up than down, but it still could go down double bottom on M1, MS1, right? Right. So it could come down and flip and then head back up. Peso. And imagine that. The dollar and the peso are about the same. Pretty amazing, isn't it? And that the trend right now is peso strength versus US dollar. Amazing, huh? And are you hearing just as much about it on TV now? Now that the peso is actually strengthening? Are you hearing about it 10 times a day? It's the Trump trade. It's the Trump trade. Oh, look at that. Good for you, right? So, cool. At some point, you would expect the dollar to get strong, wouldn't you? Where? Oh, well, we see here, and let's connect that. So sort of in this area, go back to a 15-minute chart. Uh-huh. Uh-huh. Right? So maybe some dollar strength. And then you have to watch the end of the month, but we're way out there, right? That's 2 weeks away, isn't it? I don't know what you mean by USD proof today. Okay. Yeah, no, that has not happened. No, not yet. Yeah, Hadir, I don't know who you're talking about. No, I haven't. No, I've been busy on some side projects, and when they come through, I'll probably have the time to do something like that. Yeah, yeah, because these guys are, they're funny. They when you open up a conversation, they're like, how many billion do you manage? I don't have a billion. Really? Like that's the end of the conversation. No, I'm short a billion or so. You hear of Soros, but you don't hear the other secret guys. Yeah, that's true. Of course, you guys know I'm within 6 degrees of George Soros, right? All right, and then we'll go into what should we go into? This is sort of not interesting. The East, I guess we'll have to. Yeah, the newer folks in our community may not know, but when I was 19, maybe 20, I sat on a board of directors, and George Soros was a director with me. In New York City. Wayne, you have time to trade forex 24-hour market, but what is the time you? I don't trade like that much anymore. When you have to be stuck at your computer, you're using like 15-minute charts and hourly charts. So, like to catch the London Open, for example, is a great time of the day to trade. And when you do that, you try to stay in a trade for a minimum 4 hours, but maybe 8 hours. But you got to be there London Open to watch, and that's always been a difficult time for me as a trader, especially when you start getting collecting wives and children, right? And all of a sudden, it's harder and harder to wake up at 3 o'clock in the morning or 2 o'clock in the morning. So I spend more and more time swing trading, so I can spend an hour a day or an hour a week, right? And planning things out, putting out trades and stuff, and I'm less time dependent. And so maybe that's just out of necessity, just out of necessity. That's just become the way for me. And plus, the London fake out, breakout, reversal stuff is interesting too, isn't it? Yeah. Well, there's an online educational group that does a lot of advertising. They tried to sell you like London breakout strategies. See, you just do that and you're a millionaire. Really? Really? That's great. That's really good. Sweet. So you don't have to actually know what's going on in the market. You don't even need to know about fundamentals or economic data or central banking policy or nothing. It's a trick? Really? Really? Forex is just a trick. And then you get filthy stinking rich off of a trick. Wow, that's almost unbelievable. I don't know. I can't remember what group it is. Some online trading organization of some sort. Apparently, the whole business is just a trick. Yeah. All right. So, anyways, where are we? Beast. We're kind of where we were, and I think there's some old messages in here. Let me zoom in. Okay. What are the simple rules of engagement? If you're a bear, you sell high, and where do you sell high? Well, first of all, you look at price action. Where was there resistance in the past? Let's try to get a straight line here. Maybe you bring this down a little bit. All right, can we agree that that area right there, just the red line, is potential resistance? And then let's further add to this, like this. Like this. And then I guess connect these two. There's a little higher than that, isn't it? Try to be accurate here. Like that. All right, let's zoom back in. Can we agree that somewhere around here, try to straighten this. No, that one's off. Oh, because I'm connecting this. All right, can we agree, and I guess I can add another one, that depending on how you measure it, there are sort of 1, 2, 3, 4 layers of price action resistance? This price action resistance, right? Yeah, it's the process that I'm getting to, right, Andrew? I know, right? I know I'm asking rhetorical questions, but if you actually get in the habit of responding, whether you type it, you're using a texture part of your brain because you're actually remembering how. First of all, you're thinking about it and then agreeing about it, and then you have to reach out and type onto a keyboard, which again uses a different type of brain, part of your brain. And then you type that in. There's an emotional aspect to that too, because what if I say you're wrong and it's a trick and now you look stupid? So this is using different parts of your brain. Or if you even say it out loud, now you're using the verbal part of your brain, but then you hear yourself saying it. And we know that's also like an emotional commitment, like it's a verbal contract with yourself. So even though it's a rhetorical, obvious question, you would be surprised how important it is to respond to my questions. No matter how obvious it is, you are reprogramming your brain. Okay. So anyways, we do see a lot of price action above us, which could act as resistance. And then we see there's a weekly R1 and a monthly central pivot, right? So that whole area now is an area in which you would buy, or is it an area in which you could sell? Yeah, sell. And was that part of the message yesterday? Like, if we're down here, we can't sell, but if we're up here, we can think about selling, right? The rules of engagement that I provide for you is that you can only sell at the top. Well, it's amazingly how awesome this stuff works, huh? Higher high, higher low. It's not quite a hammock because a hammock technically is a double bottom with a higher high. Important stuff though, isn't it? Right, 50% puts us right in here. That's the target. It actually went 1618. That's a little aggressive for this, but we're not. The market's not actually. Oops. The market's not actually trading Fibonacci. It's not a trick, right? It's just a way to project measurements. But you can see they're not. It went 1618, which is a little too much for this fib. But what was important is we got ourselves up to the resistance. Okay, we hit 140.50 and it stopped. Could be important, right? Cool. Hey, my pleasure, Ryan. I mean, Ryan says thanks for all that I've done in the 2155 and all these things that really help. You know, this is sort of my way of giving back, and really in a way of leaving a legacy too, right? One day I'm going to be an old man. You're going to have to feel good about what you did with the world, with your opportunity, with the people around you, with your friends and families, and right, your children, and then those who you associate with. Did you make the world a better place? And I'd like to say yes to that when I'm at the pearly gates. Did you leave a mark on society that was good? Done a lot of nonprofit work over the last 30 years, and I've done a lot of work in the forex community, and I've helped high tech startup entrepreneurs succeed in those businesses. So yeah, yeah, I feel good. So it's just my way of giving back, man. I hope you succeed. All right, so upside resistance, downside support. There's a cluster down here. Would you sell down here at 39? Hell no. I mean, it's great, isn't it? Would you sell around 140, 140.50? Yes. Would you sell around 39? No. Would you trade this weekly central? You know what? Probably not, but you could. There's something going on here, right? Top, 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 bottom, 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 top, 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 top. But I feel like this is not trending, at least from this point of view, right? I mean, this is just a narrow point in the price time continuum. But I'd rather sell it really up high. I'd rather buy it really low. Okay, but this is a potential opportunity for some. This is legit, right? You can see there is money involved down here, right? Around 39.50, but 39 just is even better, isn't it? Best. Hey, by the way, uh, in at the FX Street event at Non-Farm Payrolls, we talked about doing an event where I charge $25,000 per person. We lock ourselves into 5-star hotel for a week, and I teach you how to start a hedge fund, raise money for a hedge fund, go on road shows for a hedge fund, sit down and talk to high net worth individuals and explain your trading history and risk adjusted performance to help them make an appropriate decision for their allocation. And we have like 2 or 3 or 4 people. Yeah, and I brought this idea up like a year and a half ago, and there were 2 or 3 people interested, and there's 2 or 3 people interested now. Excuse me. We're thinking November in South Africa in Cape Town. And I need to speak to Ryan about that as well. I want to make sure he's involved. But this is for people that have money and can raise money. Otherwise, you wouldn't be able to afford it. Yeah. So, anyways, I'm too sick to talk about it. But it's just another way. I'd like to do that, or even write a book, and then do an event around the book or something. But I want to leave that too. As an old man, I want to say that information wasn't available before Wayne McDonald came around. So I'd like to do that as well. Just get it done, kind of thing. Man. Somebody's sick, huh? Huh? Somebody's sick. All right. Kiwi still got mad loves for the streets. It's the NZD. Trying to work its way around. I don't know if you're going to try to play this or not, but it's still Still got mad love for the streets. It's NZD. Okay. Well, Ryan says that the outlook for kiwi isn't good, and I'll agree with that. And dairy prices, and I get it, got it. I know it's good. I know my rhymes are tight. I wish you could. Um, what I'm thinking here is under the idea that eventually I do want to be long kiwi. I don't know if it's today or tomorrow, next week, or 3, 4, 5 months from now. At some point, I do want to buy this. Okay, and we are tickling the psych levels and stuff like that. There's something there. It may not be good, but there's something going on around 80. You know, forex, just because it drops 150 pips below 80, the big boys, they don't even notice that, right? They don't even notice that. So, like, if you had a ton of money, couldn't let's say you had millions of dollars, couldn't you just put like a standard lot here and it falls a little farther, and buy another standard lot, buy another standard lot, buy another standard lot, you know, and it drops, you know, 500 or 600 pips. It's only 6 trades. You know, if you had millions of dollars, it's just nothing. You know, it's just not a lot. Now, I don't like that type of trading. Let's be clear, but that's how a lot of people do. And then it starts coming up, and then you start buying it back up the other way, and you've dollar cost averaged everything, and now you got yourself into $2 or $3 million positions of Kiwi yen, earning interest on that, right? And all that kind of stuff. I don't recommend. I don't like buying down. I like buying up. I like buying in this market, not this market. But let's go back here. We are in a buy zone, and this is a bullish entry. Okay, this is a bullish pattern. Higher high predicts a higher low, and if you're a bull, you want to buy between here and here. We have not broken any bullish rules. Okay, and then on a smaller time frame, once again we've kind of broken out a little bit, pulled back, and again now we have an entry off a weekly central. Not the greatest in the world, but what if you were a cheeky little monkey and you were willing to risk this much pips? Where now your stop's done here. You buy off the central, you're just below here, and you're long income way. You know, you're in it for the income. You see what I mean? Income meaning the interest, and it's your first step into a bullish market. Okay, because we know like scenarios like this. I've taught you this many, many, many times. Scenarios like where I'm pointing at, and you can't see my mouse pointer, right? Yeah. This tells me that the bears are taking profit, like this did. Does it mean the bears are not going to get back in? No. But look at this. We came down to, what do you want to call this, 80.50, and it went up to 82.50, right? It was a 200 pip move, and then we continued down. Well, this is the same scenario where it could go up here and move from 79 to 80.50 or 81, right? 79 to 81. It totally could. It's done it in the past. Okay. So here's the thought, going back to this. If you can get a trade in, look, we're already missing it. So how funny is that? If you can get a trade in and then maybe jam your stop fairly quickly, or or risk the 40 pips, or maybe put in a smaller lot size and feel comfortable with that 50 pips you're risking, or whatever it is. It may be, it's just it's a way to step into a more aggressive trade, right? Because we haven't broken any rules that are bullish, right? Oops. I guess I'll go there. That is a beautiful roll reversal off of a buy zone, off of the bigger move here, which again, in of itself, is a roll reversal. It's the same trade as you see here, but it's over here. Same trade. It's the NZD. Yeah, I'll be a bull. I'm not saying you have to be a bull. I'm saying that's bullish. And if you can, if you there may be some pips in it, and it may be very few. Maybe it's only 100 pips, but you could be in it for the rest of your natural born life. See, what's the difference between, let's say, now and this time last year? Economically speaking. And I don't mean Kiwi, I mean global macroeconomics. Compare right now with exactly 1 year ago. Macroeconomically. I wouldn't be so specific. Like, I'm not talking about FOMC per se. What are the market conditions? What's the market attitude? What is the market sentiment? Are things getting worse and worse and worse? Or are they getting better and better and better globally? I'll give you a hint. China is raising interest rates. The United States is raising interest rates. So on and so forth. It's a lot better, right? So at some point, we need to kind of look forward a little bit in our bias. And, if you can get into this without losing a lot of money, or if you can get into it and then jam your stop at break even, then maybe it's worth the shot, but only under this scenario. This predicted the big high move, right? And then because of this is a higher high, it predicts a higher low, which it did. And then this breakout here predicts a higher low back into the roll reversal, which it has done. So it's a higher low of a higher low, which could be construed as maybe bullish. And then look at our roll reversal going back here, isn't it? Aren't we playing off that a little bit? I know that's not a perfect line, but okay, let's do it this way. It's this one then. Okay. Right? So we did play off this roll reversal. I mean, there's something going on here. There are bulls here. We don't know if there's enough. What I would suspect is bears are waiting above us. But maybe this is a Hail Mary. Once in a while, you need to try to hit a home run, right? Not all the time. And of course, we're talking about technical analysis, so I'm trying to help you look at things and analyze them and make decisions. Okay, it'll probably end up being like this. Great. So what are you going to do about it? Still got mad love for the charts. It's the NZD. Are you guys getting that reference? No, didn't think so. It's not coming across well. Oh, yeah, well, it's a Dr. Dre song. That's right, still Dre. Yeah, he can still provide groceries for his family, and he likes snowmobiles. He's been stuck in the lab with this pen and a pad. Signed Eminem doing 50 a week. Yeah. He and he and Snoop are whatever. Yeah, so we're identifying sport and resistance. Cool. Okay. Somebody asked about oil. Funny thing is, I already did oil, so it kind of is 100 to 1, Charlie. You don't need more than that. Shoot, make it 50. It doesn't matter the leverage per se. I want you to trade small. So what I'm concerned about is lot size. Hey, you could use 10,000 to 1. As long as your lot size is tiny, I don't care, because you wouldn't need it. So I was listening to an interview with a professional, um, and he said the interesting thing about hedge funds, leveraged hedge funds, because he was a big investor in them. He, what he said was, imagine a hedge fund using leverage, and it goes through an up and down cycle. It loses 10%, it makes 10%, loses 10%, makes 10%. What eventually happens? It's just going cycles. Makes 10%, loses 10%, makes 10%, loses 10%, makes 10%, loses 10%. What happens? No, no, no. I mean literally make 10%, lose 10%. I don't mean they make 30 because of the leverage. No, eventually you hit zero. That's the problem. So it's playing on this idea, if you lose 50%, what kind of return do you need in the future to get back to break even? Yeah, 100%. Yeah. So if you lose 10% 1 month and then the next month you make 10%, are you back at break even? Don't! And that's why it's dangerous for you guys to be break even traders. Huh? And that's why you shouldn't only scalp or only spot, because you'll never make enough money. Right? You'll just never make enough money. Well, Ryan says 3% a month is sufficient. If you average 3% a month over any significant amount of time, let's say 2 years, you'd be the best professional forex trader according to Barclays Hedge, which is an organization that tracks commodity trading advisors, CTAs. So you would be the most successful CTA in in America. Barclays Hedge. Okay. Diversify, no. That's diversify is what poor people do. And poor people hire an expert with who probably has a business degree from some third-rate university that you've never heard of, the University of Eastern West Pennsylvania, or Eastern, no, University of Eastern West Virginia. There you go. University of Eastern West Virginia, a business degree in international communications. And now they're wealth managers. Mm-hmm. You hire them, they're like, the book says I should tell you something about diversification here. Great. Great. What does diversification do? It lowers your volatility, but it won't make you rich. That's the whole idea. Like they're supposed to be managing grandmother's pearls, right? Guarding grandmother's pearls. But you're never going to make any money if you're diversified. How do you, that removes risk, removes volatility, and you certainly won't make any money because you can't make money if you have no risk and no volatility, right? But that's really good for most people that are poor. That's great for poor people. Here's what rich people do. They do all the things people are supposed to do. They buy a diversified portfolio of stocks. They have a diversified portfolio of bonds. They own some real estate. They own some, let's say, physical gold, all that kind of stuff. And they got everything, right? Good. Now you push that to the side, and they have a huge pile of money. They got some in cash too, fine. And they got some, you know, they got some other things going on, but they have this big diversified pile of money that's never going to go away. And then they have this ginormous pool of money that they could just burn and it wouldn't matter. And now they get funky. They get jiggy with it. And they go from rich to either poor, but they still are rich poor people, or they get much, much richer because of non-diversification. They need somebody like you that says, ma'am, sir, you need to go heavy on the US dollar. And let me give you 3 or 4 reasons why, and then I'll share with you my strategy for doing it over the next 12 to 18 months. Get ready for this. Here comes the USD. Boom! And there's no diversification. We're long only USD. We're going to crush the rest of the world. We're going to demoralize the Bank of Japan, right? We're going to obliterate the European Central Bank. Bank of England, goodbye, Brexit. We're going to crush these pathetically run economies. They are begging for the punishment, and I am here as the punisher. And I will carry the whip for you, sir. Right? There's no diversification. See, when you hire a wealth manager, you pay them to not have an opinion, which is silly because you should just buy an index. But you've waited so long that now it's too late to buy an index, really. But anyway, so you pay some guy 1% to buy mutual funds for you. Great, wise use of your money. Pay someone 1% to pick mutual funds since you don't want to do the work. Great. But comes a time when you got all that covered, then you want the opposite. You don't want diversification. You want a strategy. All right? So if somebody gives you money and you say, well, I want to diversify, you're fired, dude. Like, right? Then a guy gets in his Mercedes Maybach with a driver, and he's driven off to this next meeting. And you think to yourself, did that Maybach come from conservative, conservative diversification? No, he got filthy, stinking rich. All right. But where things go wrong is poor people want to do that. And by poor, if you have less than $1 million, you're poor, man. Right? You just, because you can't afford to take these risks. You can't be 65 years old and say, I'm going to take 2/3 of my net worth and I want to risk it. You can't do things like that. Okay? Right? You need high net worth individuals that want to pay you a lot of money to make the hard decisions. That's what you want, right? So if the guy says, well, I'll give you $1 million, and if you do well with it, I'll give you some more. And you're like, no, if you don't give me 5 million, I'm walking. That's the test. And if he doesn't have he doesn't have the 5 million. You're talking to the wrong guy, and he can't afford to take the risk. He's not sophisticated enough to understand what he's getting into with you, so you're going to have to politely decline. And then he's like, what, wait, what, okay, I can get the 5 mil. Really? Well, where does that come from? How are you going to raise the cash? I mean, it's cash, right? So are you going to sell some of your stock portfolio? Are you going to sell a piece of real estate? What do you got? How are you going to come up with the cash? Real? I don't have to tell you that. Well, I don't have to trade your money. Have a nice life. Whoa, wait, And you're like, you know what? I want to think about this. I just really feel uncomfortable the way this conversation's going. So why don't you keep your 5 million? Let's just regroup in a week. Let me think about it. But I'm ready. Yeah. So there's a way to do these things. So no, they don't want diversification, right? That's a poor person thing. Now that is for 99% of the people on this planet, that is exactly what they need. Right? That's exactly what they need is diversification because they're not rich. All right? That kind of stuff is needed. But you're supposed to be working with high net worth individuals, and so you need to think like a high net worth individual. Sorry again, I can't hear myself talk, so I stutter or slur or something. All right. So, anyways, I don't know how we got onto that, but there's my thoughts on diversification. If you diversify, you will be guaranteed to not make a lot of money. And for those that are already diversified, that's the last thing they need. I guess one other comment, when you go to other parts of the world and you do meet wealthy people, they live on income from your hard work. That means you're not allowed to lose the principal. None. None. You're not allowed to lose money. That's it. You don't lose the money. All right. So let's say they give you $100 million. Okay. High net worth individual. They give you $100 million. And they're expecting, let's say you make $25 million a year with that money. You understand that they live on the 25 million? Now from that, they got to pay you. Great. So let's say they got 15, 60, 70, 18 million profit, right? And just from that one investment from you, right? They have, let's say, 18 million by the time they pay for your fees and all these other things, 18 million in the pocket. That's what they live on. And they go out and they're cruising around Italian Riviera and staying in 5-star hotels and drinking $1,000 bottles of champagne and blah blah blah. Everything's good, and at the end of the year, they still have the 100 million with you. You see what I mean? They haven't lost any money. They live this lifestyle, and that's what they need you for. They're like, dude, I need more yachts. I need more 5-star hotels. I need more $1,000 bottles of champagne, and that's what I need you for. That's it. Honestly, they live off the income that you produce with the principal. You never, ever lose the principal because that means they'll just take that and give it to someone else who says they can do it. You understand? Now, you may have noticed you collected 7 million profit too, right? For yourself. Cool. So that's where you're getting. You need to be able to show consistency without ever losing the principal. That's what they want from you. Now they don't. I mean, 25% might be high, but it's an easy example. What they're looking for is no drawdowns and consistency in the outcome, because they want to say, all right, if I give Kareem 100 million, let's make it more realistic, right? Then I'll have 10 million I can live off of this year from Kareem's work, and now they can go live that. It's because Kareem is so steady. They say, you know, it's almost like collecting coupon payments. Right? It's just like, boom, the 8 million or the 10 million is going to be there. they give you 2 or 3 million. So, they can live on the 7, right? So they have to live off of 100,000 a week. That's not much, but they got some other stuff invested somewhere else. Thank you. Yeah, but see, they don't want that. They don't want the volatility. They want to look at you as like a higher risk income opportunity is what they're thinking, right? So yeah, no, we'll stay here for the news. So, anyways, yeah, if I ever do that advanced how to start a hedge fund thing, that's what we talk about for 7 days straight. Can you hear the trade in the news, guys? Okay, I'll blurt it out any second. 0.1. CPI 0.1. Both of them 0.1. So imagine you bought it here on Monday. You're still in it. And if you sold it here on Tuesday, you're still in it. Both are profitable. You're only losing money if you did something stupid. Okay. So let's go through this.
Department stores falling 1.1% in February after rising in January. Sporting merchandise, clothing, accessories all seeing declines. Electronics and appliances also moving lower in the month of February.
CPI year over year was 2.7. Still not to the 3.0. That's as expected. We've already had a 50% decline. Look at that. Just very quick, huh? That's why they call it a scalp, don't they?
At 2.586% US 10-year. 2.575% coming from the data. short end of the curve moving into negative territory. The 2-year 1.385%, so some slight upward pressure on interest rates. The dollar firming slightly as well following the release of the U.S. data. Advanced retail sales largely in line, but we saw the back month division rise notably higher. A nice beat in the Empire Manufacturing. That was the first look at March data. And a strong new orders line. CPI figures were largely in line. And the month-over-month coming in 1/10 higher than expected.
Cool. Here comes the retracement. So the 50% predicts we go more like up here, 1480. But you think we're on our way to 115, huh? We'll see. Maybe it's just not good enough. What else is going on? It's the DRE. Oh, gold. We haven't done gold. Look at down, back to the 5, 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 down, 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 back to the 5, down, back to the 5, trying to head down. Conservative target here is 1190. I think I said 1188, right? Cool, we're almost there. Was that right? 1188, was that the target? Yes, well, several days back, maybe even a week or two ago. Oh, don't click that button. Shit. Yens. Let's go yen. Good use of support and resistance too, huh? Look at this. I even got to update this. I got to drag it across. Oh, look. It's support this week. It's a DRE. So once again, if you bought, right? If you bought Aussie yen on Sunday, you're making money. Right, swing traders? You see how much better it can be where you're like, you buy it on Sunday night, your stop is down here, and you haven't done anything. It's Wednesday, you still haven't done anything. You're like, yeah, I'm in around 86.50. We're breaching 87 now. It's only 50 pips. It's not a lot of money. Right, it's the future. Well, I guess it is quite literally you trade in the future. But yeah, no, it's just yeah, whatever. It's just another trading strategy. I believe traders need to be well versed on multiple strategies. Right? It requires patience. So like here you would have bought it, and then did you stay in it? We don't know, but if you did stay in it, you got paid. Then you do it again here, and you made some money, and then maybe you lost some money, or maybe you broke even, or maybe whatever, maybe do it again here. So like, I think it often pays to be patient with swing trading. But again, you're going to be in it for a week or two. And But this is how you get punished when you're trading a non-trending market. Okay. You remember this exercise here? I said, look, there are two areas in which you could trade this currency. One here at support, one here at resistance, and the rest is nonsense. Ended up both were correct. But that is the point. There will be bulls here. There will be bears there. We just don't know how many. The trick is to have solid analysis behind your trade so that you feel confident enough to stay in the trade. And therefore, if you're risking 50 pips, you better have at least 100 pips profit, ideally more like 200. It'd be great to have a 4-to-1, certainly a 3-to-1. Right? Imagine being wrong, right? Imagine this, guys. Imagine being wrong 75% of the time and not lose money. Not nerves of steel when you're doing what you're supposed to be doing, right? If you're buying in an uptrend, but you're buying retracements back to support at levels that you've identified and you specifically chose to trade, it's a lot less risky here. I mean, you know what you're doing, and the market is agreeing with you. It's not necessarily nerves of steel. It's more of patience. You only need nerves of steel if it's gambling. Hungarian Central Bank meeting minutes coming out at 9. So, like, let's go back in here. If you had chosen to be a bull, right? There are only two places you could have traded. That's what's so cool about it. You can only pull the trigger here, and you can pull the trigger here. Okay. And you had the right market conditions for it, right? And so therefore, let's change colors. You have a very simple trade plan where there's a low of last week's market, there's the high of last week's market, they're closed, and you're doing this. That's it. It's a very, very simple trade. You don't need nerves of steel if your stop's down here. And once this breaks higher, you probably move your stop here anyways, or here, right? Now you break even. And it's not nerves of steel because you knew you were going to buy this. Okay? You decided back here that you were going to buy this. You waited for the whole weekend to buy it, and then you threw one down at the weekly central at 86.50. It's so easy and straightforward. But what I teach is it's not your technique that's important. It's not. Oops, did I just lose charts? I lost charts. Oh, I guess we're going to have to end it there. It's not. It's not the technique that's important. It's your decision. Hang on. I got Trade the News yelling at me in my ear. I lost my charts up there. All right. So, anyways, we'll wrap it up here. But it's not the technique that's important. It's not a trick like that online scumbag company is trying to sell you. It's not a trick. It's lining up the output of your analysis. Okay. You've made a decision. You're a bull on a currency A, you're a bear on currency B, you know exactly what you want to do, and through your analysis using technical analysis, you know the price in which you would consider making these trades. You see what I mean? Like, It's not nerves of steel at all. You're like, okay, I'm a bull and I can tell you 3 reasons why. Okay, great. And now, when the market opens, I will give you 2 prices in which I would consider buying. And if I don't get those 2 prices, I ain't going to trade. That doesn't sound like nerves of steel to me. You see what I mean? So if you bought this, it's not nerves of steel. Look how quickly you were confirmed. You're just like, dude, you know exactly what you're doing. And the analogy we use in the swing trading group, it's like punching a small child in the face and taking their ice cream. I know it's a little extreme. I know it's a little extreme, but nerves of steel, dude, it's a 4-year-old. Take his ice cream. What do you mean nerves of steel? I don't know. Right? What's he gonna do? Nibble your bum? I mean, come on, dude. Take his ice cream. What's the big deal? Just push him over. Take his ice cream. Right? So look, not nerves of steel. Just do your job. The rest is whether the market agrees with you or not, and you don't know that, nor do you have a way to influence that. So all you can do is exactly what you want to do. And if the market doesn't like that, to hell with the market. We'll try again next week. There's no nerves of steel. Okay. So, anyways, charts ain't working. So let's call it a day. I'll see you guys tomorrow. Peace on earth. May the pips be with you. May our profits be above average. Hey, don't touch my ice cream, huh? Cheers.